welcome back to JPX Energy Market Weekly Updates. Global energy markets are seeing record prices and intense volatility as Russia and Ukraine military conflict continues last week. Crude oil futures benchmark JPX Dubai and IC Brent hit their highest level since 2008 on early Monday trading session and then pulled back sharply as some producing countries signaled that they may boost supply. Oil prices rebounded after settling lower on Friday. Iran talks on hold is one factor supporting markets. Though the final text is essentially ready and on the table, talks to revive the 2015 Iran nuclear deal face the threat of collapse after a last-minute Russian demand sweeping guarantees that Russian trade with Iran would not be affected by sanctions imposed on Moscow, forced world powers to pause negotiations. And on early Sunday, Iran's Revolutionary Guards claimed responsibility for a dozen of ballistic missiles that struck Iraq, which added more uncertainty to the negotiations. As you can see from the black curve of the two figures, although oil prices rebounded, but intermonth spread of both JPX Dubai and IC Brent fell to 2-week low. There's a potential risk of further downward price adjustments if we see a sustained divergence between market structure and price this trading week. Although it's reported Russia and Ukraine are now close to reaching a compromise on signing the relevant agreement, it seems that sanctions against Russia will remain in place no matter how the situation between the two sides evolves. Last week, the European Commission announced proposals to phase out Russian fossil fuels by 2027, and the United States has formally imposed a wide ban on Russian oil and gas imports, and Britain said it would phase out imports of Russian oil by the end of this year. But some members of the European Union are split on whether to follow the United States and Britain. While political debates continue, some buyers appear to be shining on Russia's oil anyway to avoid reputational damage or possible legal troubles. It's estimated that around 70% of Russian seaborne oil was struggling to find buyers so far, despite record discount offered for Russia and benchmark euros. The natural gas has so far continued to flow to Europe as normal, but the European Commission had already outlined a plan to reduce EU demand for Russian gas by 2/3 by the end of this year. So market participants will now closely track Russia's export data to get a sense how much supply is disrupted. At the same time, new trade routes will emerge as Western countries turn away from Russian export. But a major question hanging over the market is where does the additional supply come from? The G7 countries called on the OPEC to play a key role in boosting oil supplies to international markets where production is not meeting full capacity. OPEC and its allies decided against raising production beyond the 400,000 barrel per day monthly production increases already in place, so supply gaps are unlikely to be filled by extra output from members of the OPEC+. Earlier this month, the International Energy Agency released over 60 million barrels of emergency oil stocks. An IEA-coordinated stock release is a rare event. This release is the largest and the only fourth time in IEA's 48-year history. But analysts have questioned how much of an impact it will really have on the global markets, considering that 60 million barrels is less than a day of a global oil demand. Besides, the oil market will face a smaller cushion due to shrinking strategic stocks, which means higher volatility in oil prices. There is increasing recognition of the need to coordinate such short-term measures with longer-term solutions if Russia's capacity is frozen. Another major question the market is focusing is whether the United States could raise oil production under high oil prices. According to EIA's latest monthly report, U.S. crude production was on track to rise from around 11.2 million barrels per day in 2021 to 12 million barrels per day in 2022, and only have been revised up by 60,000 barrels per day from previous report. U.S. rig data from the energy service firm Baker Hughes shows that drillers continue to add their rigs, but due to a shortage of oilfield materials, equipment, and labor, and dwindling backlog of wells waiting to be completed, and as many companies focus more on returning money to investors rather than boosting output, U.S. shale will likely keep a lower than expected growth rate, according to U.S. shale companies. So lastly, market participants will be waiting for some supply and demand cues from the latest monthly oil market reports of the International Agency and the OPEC scheduled to be released this week. We're updated for you on next week's program. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.